little bit about what the typical short-term loan structure is and what it looks like. So in today's market. So on a 1 to 4 unit property, I'm going to leave 5+ units out for this time because they're a little bit more conservative. But for a 1 to 4 unit residential property, most of our clients can get a 90% of purchase, 100% of rehab, 75 ARV loan. We do also have a few, what I would call 100% options, 100% of purchase, 100% of rehab to a 70 ARV. For those of you who know, that's the after repaired value. Typically, those 100% options, if that's what you like and that piques your interest, those come with a little more underwriting. They're going to make sure you got more experience, like we talked about on the last slide. They're also going to be more underwriting. We have one lender that does 100 that's going to look for 2 years tax returns. Okay, so yes, you can get it. Sometimes it comes with a little bit more underwriting. If you're okay with that, great. We've got it. Again, it's all about trying to size in what your needs are and being able to give you the best fit. So let's continue on. So the typical structure of a fix-and-flip loan is anywhere from 6 to 18 months, interest only. So there's no principal payments during that term. Most of the time, there are simply interest payments. From an experience standpoint, the majority of the lenders on our platform look for around 2+ experience in the last 3 years. That's the majority of them, but we've got 90% loan to cost options available even for first timers. So if you're a first timer, don't let that scare you away. Again, we can try to fit you into one of those particular options. The interest rates during that term typically range from 10 to 13%. So if you think about short-term rehab loans, one of the things that investors don't really understand when they think about their overall cost of financing is how fast they will exit that particular loan. We have many light rehab deals where the loan is made and then 3 months later they're all ready to refinance it into a long-term loan, or they're ready to sell it. So in that particular case, I call it a 12% rate is 1% a month. So if you only keep that loan outstanding for 3 months, it's really just a 3% charge, 1% a month before you've exited. You won't have the full 12%. But again, that is if you keep it for the full 12-month term. The next thing is lender points. That's always an area which is really important in a short-term loan. Probably the 2 most important things we hear from clients is, again, least amount of my money in the deal and how much are your fees. Because interest rates, as I just described, seems to be a lesser concern because you only have it for a short period of time. So typically, with our lenders involved in the transaction and even our exchange fee included, you're typically looking at 2 to 3 overall lender points with a particular transaction. And that's, those are the overall cost based upon the loan amount. The next thing is lender fees. Most of the lenders on our platform, in addition to the interest rate, are going to charge, some call it processing fees, some call it underwriting fees, some call it other things, but all in all, they're typically charging about $14.95 to $18.95 on every transaction that you bring in. So, for smaller transactions, that's become more meaningful. For larger transactions, it's less meaningful. So on top of those charges, you also will pay for evaluation, whatever that is. Could be a full appraisal for some of the lenders. Could be title, it's going to be title charges and then closing costs from the title company that you select. So again, giving you an idea to kind of see what the cross-section of lenders look like from an overall cost standpoint. So another thing is here we talked about earlier, minimum FICO score to kind of get the best deal is around 660. Once you drop below 660 FICO score, your loan to cost typically start dropping down. We can do 80% loan to cost down to around 620 credit score. And one of the services that we also provide to our clients is the ability to do a soft pull of your credit report at no charge. And we have another tool. Let's say you are 10 points away from the FICO score that gets you the loan amount that you want and the rate that you want. We have a tool called Wayfinder, where for our clients, again, free of charge, we can give them the specific things to do, such as paying down certain credit cards by a certain dollar amount that will then elevate their credit score to that level that they are wanting. So it's pretty precise, and it works pretty well. Sometimes it takes a month for it to show up, but it can help get you where you want to go. The next item is really liquid assets. For a short-term loan, the majority of our lenders are going to require anywhere from 3 to 6 months worth of excess reserves or excess liquid assets, plus about 10% of whatever rehab budget you have on that particular transaction. So again, for you to think about, getting that together before you apply makes sense. Do we have lenders that don't require this? Yes, we do. Some of them might be slightly more expensive in other areas of rate and fees, however. So again, I'm giving you kind of a cross section of what the majority of lenders are looking for. The next is the minimum initial advance of $50,000. Well, why do I bring this up? So we have many clients that will come to us and say, you know what, I bought a property 2 years ago and it's free and clear, and now I'm ready to rehab it. So, I just need the rehab funds. I don't need, money toward the house. And so there are some lenders that don't like opening up a loan with a zero balance on it and waiting for you to draw in the future. Some of them will require you to draw at least $50,000 and take $50,000 and refinance funds, which again, you can do with whatever you want to if you take that cash out. But again, they're just looking for a loan that has a balance from day one, and then you can carry it forward from there.